I've purchased over $40,000 in Bitcoin with the cash value in a whole life policy. And in today's video, I'm going to show you how and why I did it versus what I was doing before. First, you may have your views on Bitcoin. I just ask you to set them aside for a second. That's not the point of the story here. I want to show you what happens when you buy an asset from a whole life policy. In order to really understand this, we need to first talk about the other options available to us. So one, I had all of my money tied up in a 401k for years before this, before I had this set up. I exited that system, and I'm not saying that's for everyone, but for me, I wanted to build wealth with our dollars now. There was not a Bitcoin ETF back then, so there was no way to take advantage of what I felt like was a really great undervalued asset at the time. So after much research, my wife and I decided to empty our 401ks, move them over to cash value whole life policies, and begin to take advantage of opportunities now instead of opportunities passing us by really for years because we were stuffing a large amount of money into our 401ks. The other option is you could obviously just buy Bitcoin from a checking savings account. That's what a lot of people do. It works fine. You're getting great returns. But I want to show you why I did it this way and why this approach is actually significantly better long-term. So let's say over here, I had a savings account and I was going to buy $40,000 of an asset. In this case, it was coin. These were two separate purchases. I purchased around 19.5 and then 20.5 later at another time when Bitcoin had dropped in price. So, but we'll just say 40K to make it even and easy. Well, that savings account maybe was getting 1% if I'm being generous return. When I went to buy the Bitcoin, which is BTC, the 40K, I get this return over here, which is great. My savings account though, down to zero. I've now lost out what we call lost opportunity cost on this $40,000. That's what that money could have been earning elsewhere. So yes, I get this, or maybe I buy real estate, right? The asset you choose is really not the important part of the story here. So maybe you buy 40K of real estate. In this scenario, that's not what I did. I did Bitcoin. A lot of people are content with just this setup. That's great. Hey, I'm getting my returns in this asset. What do I care about the savings account? For me personally, I want to maximize the efficiency of every dollar. So I'm not willing to make a trade like this with my money if there's a better option out there. So let's look at what happened when I did this with a cash value specifically designed whole life policy. I already had 40K sitting in the policy. One thing to note about these policies is they always compound depending on who you're set up with, 3 to 4% tax-free, guaranteed, plus dividends. Dividends are not considered guaranteed. So you want to have those separate, but that comes out to about 5%. So already this policy in terms of at least the guaranteed constant compounding is beating the savings account. Now let's take a look at what happens when I make the exact same transaction I made before. I take that 40K and I go buy Bitcoin. What happens to the money in the policy? Well, this money has a lien on it from the insurance company. So my money actually stays put, compounding at 3 to 4% tax-free guaranteed plus dividends on this side of the ledger. And I'm getting the return of the Bitcoin. Then an added bonus, which is more like the icing on the cake is, and we don't really focus on it, but you get a legacy return in addition to this in the form of a death benefit. Now, another important piece of this puzzle is that the insurance company will not just give you their 40K for free. So on the policies that I set up for my clients right now, we have 4% simple interest for the life of the policy on any policy loans taken out. Now, some people will be like, okay, so you're getting about 5%, but you're paying the insurance company 4% on your money. So that's really not the way to look at this, because what we need to be focusing on is the volume of interest. What is the volume of interest on money that has compounded nonstop for your lifetime, for 5 years, 10 years? What happens when your money, every time you put it in here, is constantly compounding no matter what you do? When you borrow against it, it's still compounding, uninterrupted. There's no product that does that. If you take money out of a 401k or a savings account, you lose the interest that you were gaining on that. But what we're talking about here is every time you add money, that money just continues compounding. And what's in there stays put and continues compounding. So you will largely, I can't say that enough, outpace 4% simple. And also for me, if I'm buying assets, I know I can easily beat 4% simple. And that's really my only risk in the deal because the insurance company is giving me their money. So all I have in the deal is 4% simple that I have to pay back at the end of the year. I can choose to not pay the full loan back if I don't want to. So me personally, I'm happy to make that 4% simple interest trade-off if my money can always compound at 3% tax-free guaranteed plus dividends around 5% uninterrupted versus the trade-off that I would get in a savings or a checking account, or if I borrowed money out of a 401k, I have to play by somebody else's terms. With this, I play by my own terms. I set the rules of the loan. If I want to repay it, I can repay it. If I don't want to, I don't have to. All I owe, 4% simple interest at the end of the day. This is why I bought $40,000 of Bitcoin using my whole life policy versus putting it in a checking savings account and taking it out of there. Because I get the legacy return from my family. I get the internal rate of return, tax-free guaranteed plus dividends going on, and the external rate of return. And at any point, if I wanted to sell a little bit of this and pay off that full policy loan, I could. Right now, I've chosen to just slowly pay it back with monthly payments. That's how I'm choosing to pay it. Maybe you'd do it differently. That's the beauty of the system. You get to decide because you are the owner of the policy. You own and control it. This is how you leverage these policies to buy assets, which we call infinite banking. If you have questions and want to chat, reach out to me and I'd be happy to show you how this strategy can work for you too. Thanks.